All right. We're live?
Trying. It's connecting.
Okay. Well.
Wait. Yep.
Well, ladies and gentlemen, I thank you for joining us for the first of our G News with the esteemed and by many of you, suffice it to say, well-known Dr. Andrew Wilson. Andrew, thank you so much for taking the time this morning. Welcome from Sydney.
Yeah, thank you very much, Adam. Yeah, great to be here, and looks all nice and sunny up there, South-East Queensland. In Brisbane, I think that's where you are, or are you on the Gold Coast? But
yeah, sunny Gold Coast today.
Yeah, okay. Well, certainly no surprise that the weather's in your favour. I think that's what your South-East Queensland's known for. And yes, I'm looking forward to presenting today. We've got a reviving housing markets generally. We've got certainly a lot more confidence with our housing market activity now. We're moving into the second part of the autumn selling season, which is generally, in terms of seasonality, a positive period for buyer and seller activity, and we're certainly seeing that at the moment. And the latest data is certainly compelling. If I guess you are thinking of getting back into the market. But certainly a lot of those negative comments that were made, perhaps predictably when interest rates increased last year for the first time in 10 years, those doomsayers have really had to, I guess, scuttle back to where they've come from, because Australia's capital city housing markets are once again proving to be quite robust and resilient. But we shouldn't really be surprised, particularly given the mismatch we have between supply and demand.
Yeah, well, certainly if you wind the clock back, I saw a post earlier in the week where it was 12 months ago talking about property market coming off to the tune of 30% in capital cities. Clearly, that hasn't happened. We didn't get the crash during COVID. So, as you say, you can go back, it's almost year on year, and look at the prophet of doom where it just hasn't been realised.
No, they're cheap headlines, Adam. It's called clickbait. It does work in the short term. Not sure it does a lot for those that do make these predictions in terms of their credibility. We're actually going to refer to that a little bit, perhaps cheekily, in the presentation today. Two of, I guess, the more substantial parts of the conversation in terms of the housing market. And I'm talking about the Reserve Bank and the major banks. They've sort of had an oops moment, because they're now coming out saying, obviously, that they got it wrong. And that housing markets are certainly up and running now. And most are certainly predicting, as we've been predicting, that we will see growth through 2023. And I think the real element to what's reviving our housing markets and will continue to push housing market activity upwards is the fact that although prices are starting to grow again, they're still below where they were a year ago, Adam. So that's encouraging buyers, to come into the market, because those value opportunities still exist. And of course, we know that generates that FOMO energy, fear of missing out, because you want to take advantage of the value that's still in the market.
So I think this is not about you and I sitting and having a conversation. This is all about adding value to the sales partners and their clients that we work very closely with, and trying to make everyone get into a position where they're making an informed decision. So whether that decision is to sit still, do nothing for the moment, or to move ahead and make a property purchase, it's actually making a decision with the facts. And I think that's one of the things that I've learned over a period of time, is that you deal in facts rather than fiction. And that's so. With that in mind, I think obviously the key items that we're constantly speaking about. The interest rate conversation, wage growth is really important, and looking at a baseline of where house prices are sitting currently in terms of their turnaround off the bottom of the cliff that didn't happen. I then and as we go forward with this and in subsequent webinars that we have, I think that our ability to get down to an LGA spotlight word can have some real value for our different sales partners. So, as I said, this is very much about our sales partners. This is why we're doing this. So, if you're sitting watching this now, there is an opportunity for you to ask questions, and we are going to ask those questions and have them answered by Dr. Wilson. And if they're relevant, I'll answer them as well, give you my opinion on it as well. So this is think about this as a conversation rather than a presentation. Really, really important. We're doing this to add value to you and your clients, so please jump in, ask questions along the way. But I think probably first to start us off, there is some of that the big rock information that you've got so much data on. I think the right thing to do is probably hand over to you now to sort of take us through some of those headlines to set the scene for some of that detail.
Yeah, thanks, Adam. And we've got a lot of slides to go through today. I'd like to get this finished in about 50 minutes' time, so it leaves us some time for questions. So I will be looking at the main themes. There is an opportunity to get a copy of the presentation. I've also included connections through QR codes. So get your phones ready to take a picture of those QR codes, because we'll have the latest My Housing Market house price report for the April quarter available with the QR code, and also the latest April rental market report, National Capital City Rental Market Report. But at the end, we'll also have a QR code which will allow you to get a PDF copy of the full presentation, where you'll be able to, if you've missed out on getting those two reports, you'll be able to take pictures from the PDF as well. So lots to get through. It is about the main points. I just want to mention, Adam, that just alluding to what you said about the LGAs, we've got a big data set today on the major South-East Queensland LGAs. I'm not going to go through that in any depth because we would be here all day. But it shows, for those that get the copy of the presentation, they'll be able to look at it in some detail. But we are going to concentrate on a particular on a particular LGA in forthcoming events. So look out for that. We'll have a focus on a particular LGA. But today, we're just going to show what the data actually is that we have available without going into some depth. So let's get started. Time is rolling, and I'm very conscious that I've got to go quickly so we can allow some time for questions later. So I'll just get the deck up and we will get rolling. And
feel free to ask some questions along the way, and if there's an ability to chime them into the conversation, we'll certainly do that. If not, we'll make sure that everything gets covered off at the back end of the presentation.
Well, thanks for that, Adam. And My Housing Market is my brand. I work as an independent commentator, analyst and data provider. I'm all about the current state and future prospects of housing markets. I think current state is the important little phrase there, because we want to be looking at the market as it's happening rather than looking backwards, which the nature of a lot of the data we do use for housing market activity is. It's a little bit backward looking, so we try to get a little bit more real time so we can understand what's happening in the market now. I think if you're a talking head in any particular field, you at least should have some formal qualifications in that field, which I do have in housing market economics generally, but also I have classical qualifications in research. I'm also a member of the Royal Institute of Chartered Surveyors, which means I have a skill set in measurement, and that measurement, of course, is particularly the housing market and the broader economy. I've also had a lengthy career as a senior economist, a formal career as a senior economist. My last role was as chief economist for the Domain Group, and since leaving Domain, I've operated as an independent commentator. I think independent's the word. I get paid a set fee for my presentations and my work, so I don't have any real skin in the game with my clients, of which gallery, of course, is an important one. I also get my head around the media every now and again, so the media still come to me in terms of, I guess, that straight shooter type of persona that I project, and I try to stay clear of the clickbait and the fancy headlines. But you're still in the media, and we're not here to talk about me, of course. We're here to talk about our capital city housing markets in the first instance, with particular focus on Brisbane and South-East Queensland, and that is their current state and future prospects. And they're our capitals in all their glory, of course, and house prices are rising everywhere in 2023. Can you believe that? That's a headline that would have set everybody back on their heels a year ago if they know that was to come once we did start to get those interest rate increases. We're going to have a quick breakdown of the key factors that I believe drive housing markets. And of course, on the demand side, it is people. People need somewhere to live. And as we've seen through the lock-up period, that really has meant change, or migration has been a change to demand factors, the people factors. Firstly, of course, with closed borders, we stopped international migration. We have resumed that now, and of course, that's providing a significant drive into our housing markets, particularly the rental market, through permanent migrants and, of course, those temporary visa migrants, students, are putting a lot of stress on our rental markets. We also had some changes through lockdown in interstate migration patterns, particularly out of the southern states, where we saw a surge through those as a consequence of those severe lockdowns into South-East Queensland. And of course, that produced a boom in prices and rents generally. So we'll look at migration, how that's affected housing markets and likely to continue to affect housing markets. On the other side, on the supply side, we need to match demand with home building. And that's that's the big issue, I guess, in terms of housing market balance at the moment, is we're just not building enough housing. We're way short of being able to provide housing for our population, much less the surge in migration that we're currently experiencing. And that's why we are seeing particularly higher rents and are likely to see continual upward pressure on house prices or home prices as well. But the glue that holds it all together is the economy. And when we're talking about the housing market, well, the economy generally, we look to interest rates. So interest rates are an important driver of house price growth. Higher interest rates typically quell prices growth, but we don't typically see with higher interest rates sharply falling house prices. They tend to ease. But what we do see is buyers and sellers sitting on their hands as confidence falls. But what that means is when we finally get some clear air, house interest rates falling, we see the release of that pent-up demand, which I think we're seeing a little bit of at the moment in our housing markets. And that means that that exacerbates the affordability advantages of lower interest rates by releasing that pent-up demand. So typically lower interest rates results in a surge in house price growth. But the Reserve Bank sets interest rates nationally. We don't have a local or state-based interest rate. So what that means is that housing markets generally follow the trend of interest rate changes, lower prices with higher rates, higher prices with lower rates. But the rate of growth is determined by local factors. And by local factors, we mean factors such as migration, housing supply, building levels, and of course, the nature of local economy. So it's housing markets don't move in sync per se because local factors can be different, but they tend to follow the trend of interest rates. So let's have a look at that interest rate cycle over the past 20 years, and we can see that roller coaster ride. High rates way back in 2007. We had high inflation there. These are mortgage rates, average mortgage rates. Reserve Bank stepped in to do what it's trying to do now, and that's reduce demand. We got mortgage rates up to 9.5% at the end of 2007. The Reserve Bank moved into reverse gear quickly because along came the GFC, the global financial crisis, which was an international economic downturn. The mortgage rate fell to 5.8%. The Reserve Bank was trying to stimulate demand by putting more money in mortgage holders' pockets. Australia, unlike the rest of the world, was saved from declining economic activity by another strong mining boom, courtesy of expansion in China, demand for iron ore and coal. Again, we had very strong growth in our economy, too much demand, not enough supply, higher inflation. The Reserve Bank stepped in, pushed up interest rates. Mortgage rates got as high as 7.8%, but then the mining boom ended and we joined the rest of the world in cutting rates to try to reinflate our economy. Wasn't really working, even though we had a couple of blips there in terms of the interest rate cycle for mortgages, but that was a result of the banking regulator, APRA, stepping in and creating a credit squeeze really for investors, as they thought there were too many investors in the market at that time, and they were predicting higher interest rates, and of course that didn't happen. But what did happen was what those fewer numbers of investors have perhaps resulted in fewer investment properties now, which of course is meaning upward pressure on rents. However, we finally saw the Reserve Bank concede that it needed to cut interest rates sharply. It did that in 2019, and then of course along came COVID. 2020, we got our official rates down to that record low of 0.1%. That was all part of the stimulus package for COVID, along with all the other stimulus that came from fiscal policy. which put a lot of money in people's pockets. Demand was brought forward. But of course, as we know now, that did create all that stimulus packages did create inflation, as supply couldn't keep up with increased demand. And the highest inflation in decades meant the Reserve Bank had to step in again, pushing up interest rates to try to ease inflation. So that brings us to where we are now. Official rates mortgage rates are at 7.8%, but official rates are actually below where they were in 2011, but mortgage rates are at the same rate. So perhaps there's some questions there for the bank that why they've caught up in terms of, or they've got a higher lending rate compared to the official interest rate back, which was the same back in 2000, which was higher in 2011. Anyway, what we're here to talk about are house prices and how they react to interest rates, and you can see that cycle, as I said. Higher interest rates typically see house prices easing. Lower interest rates see house prices rising sharply. Again, as I said, that release of pent-up demand is a key factor there. The top two cycles there are Sydney and Melbourne. You can see how strongly they grew through the lower interest rate period. 2018, Sydney and Melbourne started to ease after those boom time conditions. That's what we typically see, that boom time conditions eventually create affordability barriers whereby buyers are sidelined from the market, and we see an easing in activity. And of course, a lot of pent-up demand is also satisfied through that period. We, however, saw perhaps a sharper correction in 2018 than we perhaps could have had, because of what was a significant fear campaign in the media through predictions that house prices would fall by as much as 40% in 2009. And of course, they were clearly wrong with that, and those that predicted that were well behind what actually happened. In fact, we did see housing markets start to pick up early in 2019. And I think we're seeing a similar rerun of that activity now, because buyers are realising those value opportunities with prices lower than they were the year before. That's what occurred in 2019. And they start to gradually move back into the market. I think we're seeing that same sort of energy now. We saw a bit of a roller coaster through COVID, lockdowns, restricted buyer and seller activity. But once lockdowns, particularly the Melbourne and Sydney lockdowns, which, as we know, were quite severe, once those lockdown conditions eased, those buyers and sellers that had been restricted by lockdown conditions were back into the marketplace, and we saw all that pent-up demand released. In Sydney particularly, there was very strong growth, but what it was catch-up growth because of those restrictions. Similarly, in Melbourne, which had more severe lockdowns than Sydney, I think we've still got some pickup in that Melbourne market, because all that pent-up demand through COVID hasn't been released. But I think if we look at that cycle, which did start to ease last year in Sydney and Melbourne after strong growth, which is the typical cyclical outcome, we can see that the patterns, and of course higher interest rates exacerbated that.
Do you have a graph that demonstrates that?
Sorry?
Do you have a graph that you can bring up that that sort of articulates sort of current house pricing across the capital cities?
Yes, we're going to have a look at a house price report shortly, Adam. I'm just going to work through the high level data, and then we'll look at what has happened with house prices in each of the capital city markets over the April quarter, which of course is the latest data that we can have at this stage. But I think it's interesting, Adam, when you look at those cycles, that we were actually getting signals from Sydney and Melbourne into the December quarter, and this is March quarter data. So these are static quarters, not rolling quarters. We can see that the cycle had started to turn. And really from September last year in both Melbourne and Sydney, there were signs that the market had started to pick up after what was a bleak winter period. Of course, higher interest rates and negative headlines exacerbated that. But if you look at the trends there, they're clearly showing, and this is, as I said, March quarter data, clearly signalling that prices were about to rise, as they have over that March quarter in Sydney.
And is there you can point to there, Andrew? You look at that shortly.
Yeah. We'll look at that shortly, Adam. Yes, we've got to get through this one. But the gold cycle there is Brisbane, and you can see how quickly Brisbane had a flatter growth cycle through the lower interest rate period. But the severe lockdowns in Sydney and Melbourne certainly translated into an exodus out of those capitals. into South-East Queensland. Record migration certainly created unprecedented demand for housing, and we can see house prices actually increased in Brisbane sharper than Sydney through 2021. And that has meant that the Brisbane cycle has started to ease later than Sydney and Melbourne, and that's why I think that the Brisbane cycle is now primed to pick up going forward for the remainder of 2023. So that's interest rates versus house prices. Adam, we'll start moving on. RBA increased those rates over May following that extraordinary decision to hold rates over April. Inflation is still significantly higher than the target range. The economy continues to boom with record low jobless, strong and rising retail sales, and house prices now rising again. So this is the cash rate, Adam, as it stands, 3.85%. As I mentioned before, it's still below where it was at the peak of the previous cycle in 2011. So I guess that's one of the reasons why we haven't had the same significant impact. Sorry?
Sorry to interrupt. I'm not seeing that graph at the moment, right?
Not seeing it?
No, not at the moment. That's okay. Look, I think your knowledge gets us through it irrespective, but just for some of those, it might make it a bit easier.
I've got some commentary here that sort of that we can work through if the slides don't come up. That's fine. You got the interest rate versus house price chart up that we had previously.
No.
Oh, so charts. Have you got a screen there with the April rate pause positive for housing markets?
No, we're only seeing your My Housing Market first slide, effectively, mate.
Oh, well, the slides aren't coming through.
Yeah. Okay, that's all right. We'll press through. This is our first one.
That's fine because I think the comment. I'll understand that, so I'll focus on the commentary. So the cash rate is at 3.85% at the moment, Adam, which is below the 4.75% peak that we had in 2011. I think the fact that the cash rate is lower than where it was back at the previous, historically, really, at its peaks, is acting as certainly an offset, and so it doesn't have the same impact that it's had, and we can see that particularly with the strong economy. The April pause from the Reserve Bank, I think, helped to bolster already reviving housing markets, adding to confidence and those value opportunities, which I mentioned before, with prices still lower than a year ago. I think that we still will get some more rate increases, but because inflation is prevailing, and we'll have a look at inflation in a second. But certainly the economy is booming. This is one of the strongest economies we've had. Another stunning result over March for the labour market, and really no justification for that rate pause in April, given the data as it came out. We have an unemployment rate steady at 3.5%, Adam, which is the lowest monthly result on record. And we have to go back to the early 70s to see a similar, unemployment rate. It's a different Australia compared to the early 70s, which was basically a single household environment, single income households. Now we have multi-income households, and we're still getting unemployment rates this low. And the other point to that is that all our states and capitals are recording record low unemployment levels. So it's not about one state standing out. All our capital cities are recording low unemployment rates, and they're all tracking lower than where they were a year ago. As I mentioned, the jobless rate was steady at 3.5% over March. We had an extra 53,000 jobs created, so that was 2 months in a row with significant jobs growth. The unemployment numbers fell, lower by 1,600. That again was 2 months in a row with a lower number of unemployed. The participation rate was steady at a very high 66.7%, which means that basically everybody who wants a job can get a job. In a sense, it means we're getting a lot of retirees and small business owners who are moving into the workforce because of all the opportunities. All our capitals are reporting low-level unemployment rates, and really those rate increases of last year and into this year have had no impact on the real economy. Retail sales data, yep.
sorry to interject, but do you want to just try unsharing your screen and then opening it up again? I think the quality of this data is just too good. One of the things I love about your information is its currency. You know, we look at the Reserve Bank and these other institutions where we're getting data from, and it takes us back 4 months. You're talking about information that is 11 days old. And I just think that's phenomenal for those of us that have been in the industry for some time. Currency of information is so important, so that we're not talking about 90-day information. It makes all the difference in the world.
Yeah, well, that's the point. And as I said, it's about current insights. So a commentary has to follow the data, obviously. And if you're commenting on data that's 6 months old, 3 months old, 12 months old, which is some of the data that is presented, you're obviously looking backward, and it's not telling you the full story. Now, it doesn't mean that there's a single data set that you can rely on. I think it's also important that you have numerous data sets to be able to support your argument. And that, as I said, they're as real time as you can get, but they're all part of the jigsaw puzzle that you're putting together to paint a reliable picture of what's happening in the housing market and what's likely to happen. And I think if you're a buyer and seller, that's important that you have that information to support your decision-making process. Will we share the screen again, or will we keep chatting?
No. Let's give it another try and see if we've got the current slides, right?
All right. Okie doke. Slides up.
Mm-hmm. We have a winner.
Beautiful. All right, then. So the button's been pushed. Now, I was talking about retail sales, another part of that strong economy. And retail sales increased again over March and still at very high levels. So consumers are still quite active in the economy in terms of retail sales. Wages are rising. We get the latest wage data out soon from the ABS. This is the December quarter, a little backward looking, but we do have wages rising at the fastest rate in 10 years and likely to continue to rise given the shortage of labour that we have, and that workers are certainly taking advantage of that and bidding up their wages. Inflation is the key to interest rates, of course, Adam. We had some better news on inflation over the March quarter. In a sense, this is underlying inflation, which takes out the volatile elements. So underlying inflation fell to 6.6% from 6.9%. Headline inflation down to 7% from 7.8%. March quarter was lower than December quarter and the March quarter last year. Travel and gas were the main contributors to inflation over the March quarter. New homes prices or costs fell, and that was an offset to travel and gas, and fuel costs were also easing. The bad news was that services prices continue to rise. They're the highest since in over 20 years, and goods prices were easing, but it's now the higher wages are pushing higher service prices as employers have to cover higher wages if they want to keep their workers by putting up their prices. And we're seeing that now, and that's a concern in terms of controlling inflation. So
Andrew, with respect to inflation, I'm going to ask you the I'll call it the inflation 101 question. We hear about the bucket of goods that determines inflation. Can you, for the non economists in the room, can you just in really simple form for the dummy help me understand better when we're talking about inflation, that bucket of goods and what drives that?
Well, the ABS determines what we typically spend in terms of a household on what, and then they weight the items according to the proportion from your income that you would be spending that on, right? So it's the goods and services that you spend your income on, and then it's the level, the proportion of what you spend from your income on those particular goods and services. Obviously, housing costs, shelter costs have a higher proportion than other items which have a lower proportion. Food has a higher proportion, and that's revised, periodically to make sure that they're still covering the same items. The key inflation measure for the RBA is what's called underlying inflation. So that takes out seasonal elements such as food, because food costs can change with the seasons. So it just looks at the real grit, the main underlying costs that households have to get a steadier result. Now, the Reserve Bank has a target. It's 2 to 3% for underlying inflation. We're at 6.6 at the moment. So that really tells you the story that even though we've come down from our peaks, which was nearly 8%, we're still way above that 2 to 3% target, where we are at 6.6%. And one of the factors that is important, Adam, is building costs. And that's been a contributor to higher inflation. If we look at the latest building cost data, some better news there. Building costs, of course, surged as a result of the home builder package, which was released by the previous government in 2021, early 21, created a boom in demand for new houses. We didn't have the labour or materials to cover that demand, so prices went through the roof. We're just starting to see now consistency in terms of easing, and this is a quarterly index of building costs for houses. But even though the latest data over March shows us that house building costs eased marginally, results are still very high and are placing pressure on home building profitability. So this shows you the quarterly change in house building costs on a month-by-month basis, down to 16.5% per annum, but it's still too high. And one of the problems here is that high building costs mean that it's constraining supply. So it makes it even harder for a builder to get those approvals out of the ground because of the difficulty with matching their financial agendas with these very high building costs. Another important factor, yes.
Okay, for those of you that are joining us, we've just got a bit of a challenge in that screen sharing. But I think most importantly, to Andrew's point earlier, this presentation is available to all of you that are sitting here today. So make sure when Andrew shares the QR code, you grab that, because there is lots and lots of data there that I would suggest to you is invaluable. So please make sure you take the time to do that, so you've got this to reflect on over a cup of coffee.
And you're still seeing this. You've got the screenshots there of the presentation still, Adam?
Seeing the retail sales data at the moment.
Retail.
So, yeah, retail sales is the screen that we're looking at.
I think that's the one we went into. So we've gone on from that. So it's frozen there. Yeah, it's free. Yeah. It's not showing the transitions.
No.
Which is the problem.
Press on. That's it.
I'll press on. So we were discussing inflation. Building costs have started to ease, but they're still at very high levels. The price of oil has fallen significantly. It's steadied over recent months, Adam, but that's been another reason inflation has fallen. So really, there's still a way to go to control inflation. And that will mean, in my opinion, higher rates. But at this point, interest rate rises have been shrugged off by consumers, as we've seen with that very strong economic data. Let's talk about migration. We shut our borders. Our borders are open again now. The target is around 200,000 permanent visas per year for Australia. Of course, they've got to find somewhere to live, and in an undersupplied market, that's problematic and certainly means higher rents and higher prices. We've seen a big rebound in international migration or total migration since lockdowns changed. So it's come with a rush, and I think we're seeing the consequences of that with higher rents and higher house prices. Queensland's still leading the pack in terms of net migration. The latest data we have is the September quarter, which is a bit backward looking, and that does cover that period where we had strong interstate migration coming out of New South Wales and Victoria into Queensland. Interestingly, New South Wales has been the top performer over the year to September for international migration, but typically New South Wales and Victoria are the top performers for destinations for international migrants. Interstate migration still well and truly in favour of Queensland, head and shoulders above the rest in terms of
I read a main report, Andrew, that indicated that between now and the end of 2024, the forecast is for circa 700,000 people to make their way to our sunny shores? Is that
Yep.
your understanding?
Well, there'll be more rather than less. And one of the significant factors, of course, is that we're now seeing students re-entering Australia, international students. And a significant driver of international students is China. And China, of course, is now out of its lockdown policies. And it's actually encouraging international students to head for or to secure an overseas qualification. Also, interestingly, Adam, our major universities are saying, well, they want to shift from a virtual world or virtual learning to face-to-face. So, that means more students coming into Australia. And of course, students typically look at the at rental markets and permanent migrants initially for their housing. And that means particularly in those areas where are close to higher education facilities, are under a lot of stress in terms of trying to provide accommodation. And that means higher rents going forward. And when we look at the data for Queensland in terms of its annual migration numbers, the latest data is 81,000 net migration. So that's the difference between people leaving the state and coming into the state. And that shows a remarkable surge in 2022, 81,000 over the year to September 22, compared to just 33,000 in 2021. So that's a key driver of the housing market and rental boom in South-East Queensland. On the supply side, we've got all that demand coming through, Adam. The latest building approval data is we saw that building approvals fell again, down by 0.2%. Units were up, however, but that's a volatile measure from month to month, up by 5.6%, but houses were down 2.8%. But the big picture is that total approvals remain 18.3% lower this year compared to the same period last year. However, the Brisbane market is bucked the trend with an increase over this year so far compared to the same period last year of 9.7% in dwelling approvals. However, all the other capitals have fallen significantly. Sydney's down 40%. But even these approvals, as I mentioned before, will struggle to become commencements because of the higher building costs at the moment. So the proportion of approvals is likely to be that translate into commencements will likely be significantly lower because of high building costs, and that only exacerbates the undersupply of Australia's housing markets. The long-term trends are certainly showing.
If you pick that information up in terms of the lower supply of housing, significant influx of migration, there can only be one thing that happens in terms
That's
of
right. And it's happening.
rental demand.
Yeah,
We're seeing that clearly with our rental management business, where we have literally a zero vacancy rate in our rental management business.
Yeah.
And you're seeing that with the empirical data. It doesn't take really an economist to be able to say if you have substantially increased supply, demand, I should say, and a lack of supply, what is the outcome?
Yeah, that's right. It's higher rents and higher prices. And the problem is, Adam, there's nothing you can do about it. We had the budget on Tuesday night, which really, acknowledges the problem. I mean, all governments acknowledge the problem, but there's nothing they can do about it because we're really a million homes short in a sense. The budget really just addressed public housing, to try to offset those at I guess the lower financial end of the scale, their problems that they're having with the rental market. But the great, the broader part, the great majority of tenants move through the private sector rental market, the private rental market, and there's just no relief there. And the point is that we're seeing, very strong increases in rents for new listings, and eventually this will work its way to those with existing leases, and that is not new listings. So that'll mean higher inflation because housing is a significant part of the basket of goods for inflation. So we've still got, upward, because it'll take a year or more for those higher rents in new listings to work their way through the whole rental market. So, and that's going to mean, more bad news in terms of inflation, I believe. So yeah, home building approvals down again. In fact, the big picture is that the trend for home building approvals nationally is down 25.1%, Adam, since 2015 at its peak. So we've clearly underbuilt, despite that surge that we had through Home Builder in 2021. And as I mentioned, Brisbane's the only market over this year so far to have recorded an increase in dwellings compared to the previous year. And it's interesting now that Brisbane is now approving more dwellings, Adam, and more units than Sydney, which reflects, that real undersupply in the Sydney market, which Brisbane is, Brisbane is now building more than Sydney, or approving more homes for building than Sydney, which is good news in a sense for the Brisbane economy, but it's still undersupplied compared to the rest. We had the latest home loan data out, Adam, for March. That was released last week. And as I was speaking about before, it's correlating evidence with what we're seeing with higher house prices. Housing loans have now increased by over 2 consecutive months. So that's reflecting what we're seeing with prices. And also we're seeing investors, owner-occupiers and first home buyers all increase over the past 2 months in terms of 2 months to March in terms of approvals for loans, for home loans. And first home buyers, perhaps not surprisingly, have the yep.
That data that comes out, does it talk to both the total volume of loans, but does it talk about the per loan size as part of that information, or is that getting too granular?
No, we get that data, and of course it shows that the loan value has fallen as with lower prices, but that'll now start to pick up. I think the fact that we saw a big surge in first home buyer activity over March reflects the fact that first home buyers are really wanting to get back into the market. Prices are lower than where they were a year ago. And of course, their savings capacity is being constrained by skyrocketing rents. So no surprise, first home buyers are up and running now, given prices starting to rise again. And of course, the underlying conditions of strong wages growth are improving the capacity of first home buyers to save. So I think we'll continue to see strong first home buyer growth. Not surprising, as we've said about that renaissance in the Queensland market. Actually, Queensland was the top state performer over March, Adam, for home loans, up by 9.3%, and that was the best of all the major states. So a good result there. We've mentioned the rental market. We'll have a quick look at rents in terms of Brisbane's median rent now is at $573 weekly. Its unit rents are at $550. Sydney unit rents and house rents are now both at $700 a week. What we're seeing is a narrowing of the gap between unit rents and house rents because, tenants are being forced now to look for more affordable accommodation, but that, of course, is pushing up the rents of units, which are now starting to match those of houses. This is April data now that we're talking about in terms of the rental market. We have, despite April being typically a quieter month because of holiday distractions for landlords and tenants, new tenants, we still saw house rents rising over April, and Sydney unit rents were up by 3.3% over the month, and Brisbane unit rents up 1.9%, Adam, over the month. And when we look at the annual data, that's just unbelievable. We have got house rents in Brisbane up 27.2%, which reflects what you were saying previously, and unit rents in Brisbane up by 22.2%. Sydney unit rents up 40% over the past year. Melbourne unit rents up 25%. But we must mention that both those unit markets in Sydney and Melbourne are coming from a very low base, which reflects the high supply that in the inner city areas of Sydney and Melbourne through lockdown. But they're catching up quickly now. And as I mentioned, Sydney rents for units are the same as houses over April. Vacancy rates, only Sydney has a vacancy rate above 1% for houses. And of course, this is the April vacancy rates, which were a little higher owing to that holiday month scenario. And all the rest under 1%. And only Sydney and Melbourne are above 1% vacancy rates for units. And, it's irrelevant in a sense because anything under 2% is a tight market. anything at around 1% or lower is a market where basically, as you suggested, Adam, there are no vacant properties. So house prices.
It really is. It's quite staggering when when you see an open house for a rental property now. You would swear people are waiting to get on an aeroplane. There is a lineup 20, 30, 40 deep for people at rental properties, whether that be in Brisbane, Gold Coast, Ipswich, Logan, Moreton Bay. It really must be for that part of the market. Those people that are having to stand in that line, it must be quite distressing to have to go through that process, recognising the depth of competition there is to actually to find a rental property.
And there's no relief in sight, Adam, because firstly, as we've seen, we're underbuilding. That's not going to in any way be a replacement factor for that shortage. And of course, we've got very strong wages growth. So there's the capacity for tenants to push up, rents based on higher wages. So it's something that we're going to have to live with, and unfortunately, will mean, I believe, social consequences going down. We've just got to really free up the capacity of builders to build, and that's going to take some big changes going forward. I'm not sure that's doable in the short term. So we're just going to have to get used to the fact that it's a very tight rental market. It's here to stay, and really, it just focuses on the value of being a homeowner or a home investor, going forward. I just want to have a quick look at what happened last year in terms of house prices. There was a lot of predictions that were made. In fact, last year we only saw, if we look at the December quarter to December quarter performance for our capital city markets, it was only Sydney and Melbourne where prices fell over the year last year. Brisbane was up 3%, Adelaide up 4.3%, and Perth up 6.9%. And in fact, units outpaced houses last year. Brisbane units up 11% last year, and Adelaide up 10.1%. Sydney and Melbourne were also lower. So, in fact, we look at the long-term situation in terms of national house prices. There's only been 4 periods where we've had national house prices fall over the year. The last one was in 2018. Then we had 2011 and 2008. And the worst we had was that 5.5% in 2018. So the 4.3% that we had last year was certainly, around about what we'd expect, and way lower than what was predicted by a number of analysts. So I've got the latest housing market data here, Adam. So national house prices over April quarter. So this is the quarter of April versus the quarter of March. We're up again for the third consecutive increase. So the national market is clearly bottomed out. Brisbane was up, and I've got the slide deck which will be available to everybody, but Brisbane was up by 1% over the month and still flat for the year. Sydney's the best performer over the year so far, up by 3.2%. But as I said, prices are still below where they were a year ago, so those value opportunities are there. The national median unit price also increased over the quarter compared to the previous quarter. But Brisbane's had some strong results for unit prices this year so far, up by 2.6%. Again,
if we can pinpoint the capital cities, if you've got the information there, from peak, I'll call it peak to trough, linking against the 30-40% reductions that were touted. What was the peak to trough for Melbourne, Sydney, Brisbane? Just interested to understand some of those numbers to then say, okay, where are we today, excuse me, in Brisbane, thinking about what the projections might look like.
Well, I'm going to give you some forecasts for this year at the end, quite shortly, Adam, because we're running out of time. The full year, what we can look at is the change over the full year, because basically that will give us, adding on the change that we've had over the last couple of months in terms of positivity. In other words, this year we're up 3.2%, but the full year in Sydney to date is 6.9% lower, and 5.5% in Melbourne, and Brisbane it's 4.4%. So we're
Okay.
looking at around about 9% in Sydney, 7% in Melbourne, and around about that 4.4% in Brisbane, peak to trough. The point is that it didn't enter double figure growth in Sydney or Melbourne, and it was around about those sort of long term averages. But clearly, house prices are rising again now. 3 months in a row, Melbourne and Sydney have their cycle has bottomed. It's not just a one-off. We've had 3 months in a row for Sydney, 2 months in Melbourne, and the forward indicators, which we'll look at to conclude today's presentation, which is the auction market last weekend, are really quite spectacular going forward in terms of the prospects for our markets. As we mentioned before, those predictions that were made of house price crashes last year have proven to be wildly inaccurate, and we've had statements now from the RBA and also from the major banks that they were wrong and that they believe that the weakness in the housing market is now behind us. My forecast for this year for Brisbane, I believe house prices in Brisbane will rise by 5%. These are mid-range forecasts for this year,
Yep.
and I think Brisbane units will rise by 8%. I think there's a bit more upside to that Brisbane market than the 5%, but nonetheless, when we put that together with what's happened over the past 2 years, it means quite strong growth overall in that Brisbane market, which will likely start pushing around about 40% over 3 years for houses, Adam, which is a very strong result. Now, I'm not going to go through all the data, which I mentioned at the beginning. We've got all the LGA data. I'm going to come up with a slide in a second, which gives you all the presentation is a QR code. I'm going to go back to unsharing, and then I'm going to put up the QR code, and everybody out there can take a picture with their phones of the QR code. Just got to get through to the back end of the presentation. So they'll have full access to all the slides. They will also be able to access the QR codes for the My Housing Market April quarter house price report and the rental report. I'm just going to finish off now. Last week we had the first auction clearance rate data for weekend auction results for May, followed an increase, of course, in interest rates. We had spectacular results. Sydney recorded a 79.8% clearance rate with higher listings. Melbourne 78.1%, Brisbane 74.7%, Adelaide 90.5%, and Canberra 75.2%. These are remarkable results, Adam. Very, very strong, higher listing numbers. We are now starting to think about that B word, which is boom, in Sydney and Melbourne. Once we start getting to consistently 80% clearance rates, we will see strong prices growth. Follow that. There's a clear correlation between auction clearance rates and house prices. So everybody, I urge you, and clearance rates are now tracking in all capital city markets higher than where they were a year ago. The clearance rates, the data, the auction market data is available on my LinkedIn channel, Doc Andrew Wilson, every Saturday night, the headline results. And on Sunday mornings, also, I release the regional results with some commentary. So just summarising everything that we've done today, Adam, under some difficult circumstances, the inflation outlook remains clouded, of course. Will interest rates peak lower and earlier than predicted? However, the still booming national economy is well positioned to absorb higher rates. House price growth eased last year, but decline levels certainly improved over spring and rose early this year. Rising interest rates, as I discussed, constrain prices growth and typically impact confidence in the shorter term. Underlying demand, as we've pointed out, remains well above supply, reflecting that recent underbuilding and the resumption of migration. Housing market rebounded significantly sooner than most predicted this year. Home prices now clearly rising this year. Sydney and Melbourne have bottomed out, with that fear of missing out energy now set to emerge with those value opportunities. Latest auction results continue to support the prospect of rising confidence and activity through 2023. And South-East Queensland, I believe, is now primed for a housing market rebound, strong economy, rising demand, lower supply, and those value opportunities. as a result of prices being lower now than where they were a year ago. I think just finishing off, it's important, and we've discussed this, Adam, that to acknowledge that misinformation and ignorance remain the curse of Australian housing markets. All those cheap headlines and that clickbait, that's okay as long as you don't make buying and selling decisions based on those extreme points of view that we do get promoted in the Australian media from various analysts and commentators. But of course, if you rationalise the data and also act on the fear that it generates, that misinformation and ignorance, it'll be a positive for decision making going forward. And that's what we've tried to do today. So there's nothing to fear but fear itself in regard to that continuing to prove itself robust and reliable Australian housing market. So demand is ahead of supply, confidence is reviving, and prices are now on the rise through 2023. So what I'm going to do, Adam, is just stop the sharing for a sec.
Sounds good.
And
so for next month, we are going to send a call out and look to give you an opportunity to use what LGA you're looking for. You've got something to share now, Andrew?
Yes, I have. And we're waiting for the window to come up. Have you got sharing activated there?
Not seeing it at the moment, mate.
Oh, hang on, I'm going to start. It's not coming up.
No, not seeing it at the moment, unfortunately.
No, it won't let me screen share.
Right. Okay. Well, we've suffered the indignitude of some tech issues today, folks. Thankfully, Dr. Wilson has a plethora of information that we're more than happy to share with you all. And I think that's one of the real values of Dr. Wilson. Typically, an economist with such intellectual property that he has is normally fairly tight-lipped about it and unwilling to share it. This is all about, as we said at the outset of today, it's about giving you the tools to give you better informed clients. So if you can, we'll get this information to you and you can share it with your clients and answer those questions that are holding people back from making a decision. And we consistently talk about confidence, certainty and clarity. And the thing that I believe Dr. Wilson does more than anything else is gives anyone that listens to it objectively those three things: confidence, certainty and clarity.
Thank you, Adam. And look, what I'll do here is if you'd like to get onto my LinkedIn channel, which is Doc Andrew Wilson at LinkedIn. It's a big channel, but I'm sure if you're not members already, then I will put up a link to this. Well, if you can request it, coming through, obviously, this presentation. So we narrow it down to those that have attended. If you'd like to request a copy of this presentation, I will send it to you through my LinkedIn channel, so we can sort of cover that going forward. So Doc Andrew Wilson at LinkedIn, and I will give you a PDF copy of the presentation if you request it. Just send a request to me, so we can cover all bases. And next time we'll be 100% rocking and rolling in terms of what we do. Right?
Again, thank you, Dr. Wilson. As always good. Exceedingly informative. And again, for those of you that joined us today, this is not for Dr. Wilson and I, this is for you. So anything that we can inform you with to make you more successful in your respective businesses, please send that through to us. This is content for your benefit, not for ours. So thanks very much, Andrew. I hope the weather in Sydney town is as beautiful as it is in Queensland today. And
we'll struggle, but it's a nice day. But a lot of people are on. Thank you very much, Adam, and good luck, everybody. And we'll catch you next month when we'll have more real-time data available, certainly close to real-time data available to discuss.
Fantastic. Thanks, one and all. Cheers.